Thank you for joining us for the Multifamily News Minutes for December, brought to you by Sales Inc. With accelerated apartment leasing solutions, Sales Inc. delivers measurable return on investment with their pay-per-lease model and proven leasing agent techniques. Now, on to our December multifamily news. It's been a strong fall season for multifamily construction, with last month's Architectural Billing Index rising for the fourth consecutive month, according to the American Institute of Architects' latest report. This is good news, since earlier this year, new multifamily construction was at an all-time low. The new index of 53.2 is the highest score seen since November 2007. This trend in growing demand for architectural services is linked, experts say, to jobs numbers. The Bureau of Labor Statistics reported adding 2,400 engineering and architecture jobs this fall, a major factor in cross-sector growth. For the multifamily housing sector, the index reads 55.9, the fifth consecutive month of gains. Those following the multifamily market know that new multifamily construction was in very bad shape earlier this year, at nearly 60% below the long-term average. Coupled with a surge in rental demand, March of this year saw a 2.5 million unit imbalance favoring the demand side. These growth numbers are good signs and correlate to the activity we have seen in markets such as Houston, Washington, D.C., and oil boom North Dakota. Millennials, or that tech-savvy age group who is now entering the workforce, will also be satisfied by an increase in construction, as that group tends to prefer Class A properties in highly desirable areas. The emerging housing recovery is cause for optimism amongst multifamily construction firms. According to the National Multi-Housing Council, household ownership rates are projected to decrease from today's 65.5% to 63.2% over the next 7 years as a result of a growth in the renter's share of new households, according to the National Multi-Housing Council's annual newsletter. Historically, apartments have made up approximately 45% of the housing market share, but the recent housing bust caused a decrease in new apartment supply as homeowners transitioned into rental properties. This gain was, however, mitigated by the increase in single-family rentals. The report has several projected scenarios for new housing construction, of which the narrowest growth would add at least 240,000 new multifamily units. The largest amount of growth, or at least 1.2%, would create demand for 437,000 new multifamily units each year until 2020. The multifamily market is heating up in the Garden State. Investors eager to close deals before the end of the year, particularly before the Bush-era tax cuts expire as a result of the fiscal cliff, have driven sales for a New Jersey firm 50% during the fourth quarter compared to last year. The velocity of multifamily sales is expected to slow in the beginning of 2013, especially if the capital gains tax rate is raised. A squeezed supply chain of new development, coupled with rising demand for rental units, offers landlords greater leverage to increase monthly rent by a projected 4.2%. With multifamily properties still maintaining their reputation as one of the safest returns on investment, and the supply pool continuing to shrink from lagging construction, competition among investors for New Jersey apartment buildings ramped up in the fourth quarter of 2012. Though a local multifamily expert said sales activity will cool down at the start of 2013, especially if the capital gains tax rate spikes from 15% to 23.8% on January 1st. Despite the looming fiscal cliff, Thomas McConnell, a senior associate at the Elwood Park office of Marcus & Millichap, said the sales pace could continue through 2013 if interest rates on multifamily loans are held at today's extremely low levels. Though, quote, if they tick up even a little bit, I think sales and sales prices will drop, close quote. At the same time, rents are expected to edge upwards. It is anticipated that effective rents will reach $1,313 a month by December 31st, a 4.2% increase from the start of the year, compared to the 2.3% increase in 2011. Don't let the average fool you, however. There are great differences in demand fundamentals between Class A and Class C property types. While the newer Class A product built a near-transit hub has a different rent margin altogether. The majority of the product out there are older garden communities that have been in existence since the 60s and haven't been updated in years, McConnell said. Quote, "So for the market as a whole, I think rents are now as high as they'll get." And finally, the U.S. multi-housing vacancy rate is expected to rise slightly to 5.3% in the new year, even as the multifamily housing market continues expansion from 2011. According to the most recent CBRE Group Inc. study, newly completed construction, as well as diminishing demand, will drive the vacancy rate from 4.5% reported in the third quarter. Researchers forecast the rate to drop to 5.2% by the end of next year. Geographically, CBRE projects that top-performing multi-housing markets will be those with heavy concentrations of high-tech employment, most notably San Francisco, Denver, Austin, and Atlanta. Those markets where total employment has already surpassed pre-recession peaks, such as Houston and San Antonio, are also expected to do well. Finally, strong cyclical recoveries in rents are also expected to start in some of the cities hardest hit by the housing boom going bust. These markets, which include Orlando and Phoenix, should lead the country in rent growth. It is a great time to own multi-housing properties. Apartment demand is benefiting from the slowly recovering economy, as well as rapidly expanding pool of renter households, said Gleb Nachayev, senior managing economist of CBRE Econometric Advisors. Rents have now surpassed previous peaks in most markets, and vacancy rates are below historical averages. The market entered an expansion phase in late 2011, and since then, fundamentals have continued to improve steadily. New supply has also picked up considerably as a result of strong fundamentals. Completions are on track to return next year to the 1998 to 2008 annual average of about 190,000 units. At the same time, CBRE anticipates that growth in demand will slow, leading the vacancy rate to tick back up to its historical average of 5.3%. That's it for the Multifamily News Minutes, brought to you by Sales Inc., your accelerated apartment leasing solution. If you own a property currently experiencing low vacancy, whether it be Class A, B, C, student, tax credit, or military, Sales Inc. can turn your leasing around. Sales Inc.'s pay-per-lease model guarantees return on investment, increasing property value and monthly revenue. Find out more how Sales Inc. can optimize the occupancy rate of your properties quickly and easily at salesinc.net. Join us next month for the most important multifamily news for January 2013. And from all of us here, we wish you success and prosperity in the new year.